traditionally you cannot buy a house with 1099 income for at least 2 years because you are considered self-employed. Therefore, you have to have 2 years of tax returns. Um, I know you guys don't necessarily do that. You guys allow people to go in before 2 years. So talk a little bit about that. Like what would you have to have? Like a month or two, 3 months, a contract? Like what are you guys seeing for independent contractors?
Yeah, great question. And again, we bend over backwards for medical professionals to find solutions and get underwriting approvals and get families and homes. So let me start at where this problem originated. And in 2010, in the wake of the Great Recession, the Dodd-Frank Act was enacted, and part of that legislation, which was meant to protect homeowners from being taken advantage of by predatory lenders. But as many things the government does, there's unintended consequences with that legislation. And one of the unintended consequences was from a provision of that act called the ability to repay rule. And basically, what it says is it is illegal, like literally against the law, for a bank or lending institution to loan against a primary residence where a family is going to be living in that home as their primary residence without proving the borrower's ability to repay the mortgage, proving it. Now, that opened up a huge amount of gray area. Well, what is considered proof of income? And so, what was accepted as industry norm and what Fannie Mae, Freddie Mac, which is the conforming loans, FHA, VA, and most jumbo loans, they've all agreed that to prove a self-employed 1099 is lumped in with self-employed. In order to prove that income, they want a 2 year history because they want us and 2 year tax return history. So you could actually be self-employed 3 years before you get your second year tax return because they want to see not only the income, but they want to see your deductions. And typically, not necessarily the case with medical professionals, but typically self-employed people can have huge fluctuations. I mean, they could have monster years followed by really slow years, and they want to average those 2 years out. So conventional underwriting guidelines say 2 years tax returns, average the income over that 2 years. If you don't have it, so sorry. Um, that is not the case with medical professional loans. So we have programs out there that if you have an employment agreement that is predicated upon 1099, but that employment agreement gives you a guaranteed daily or a guaranteed monthly or a guaranteed weekly or a guaranteed hourly and a set number of hours, we can do that loan before you even start your new job, just based on the construct of your contract or offer letter. If you're already on the job and you have those kind of same fixed characteristics, we can do that loan. Here's where it gets really tricky, Joe, is if you're on a variable income structure, like you get paid X number of dollars for this procedure or Y number of dollars for these hours and X number of dollars for those hours. So if your pay is kind of incentive based or production based in some way, it gets harder to document and harder to prove an ability to repay. But all that means is that you would need to bring in larger down payments amounts, perhaps maybe as much as 10% or 15%. There's almost always a solution. So if you're newly 1099, newly self-employed, somebody else has said no, you need a second opinion, and we'd love to help you.